Okay, welcome to the May 2023 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The title of this month's video is Toothpaste Tech is Concealing the Market's Bad Breath. So I'm sure you've heard and read a lot about this big discrepancy between what the indexes appear to be doing and what's happening beneath the surface. I think this is a really important discrepancy. These kinds of divergences are what we often find at major turning points in the market. So we're going to want to make sure we're paying attention to this and giving it its proper due. Before we get started, just a quick review of your favorite part of the video, the important disclosures. Okay, so Toothpaste Tech concealing market's bad breath. So with the S&P holding above the March 6th close, and I'm referring to the March 6th close because that's the day before Silicon Valley blew up. The fact that the market is above that March 6th low, March 6th close, I should say, one could easily conclude that we've somehow managed to dodge a major banking crisis bullet. And on the surface, that would be a fair conclusion. However, the reality is that the average stock actually remains underwater since May 6th. And the average bank is actually down about an additional 15% since the S&P bottomed on March 13th. So while the S&P is going higher and has recovered above its March 6th close, banks actually have fallen an additional 15% on average since that day, since the market bottom. So there's a massive divergence going on here. And again, I think this needs to really be reflected in portfolios in terms of risk budgets and exposures, which of course we'll talk about. So Toothpaste Tech is basically these companies that have recurring revenue streams. And this harkens back to the Nifty 50 of the 60s and 70s, where companies were, the valuations that were assigned to some of these companies were egregious, but and they were admittedly egregious even then. But the idea being that you can pay whatever you want for these companies because if you hold on long enough, their revenue streams are so reliable and dependable that whatever you pay today will ultimately be bailed out through strong price appreciation due to these phenomenal underlying fundamentals. And so most of those companies today are tech companies. But because they have this recurring revenue stream, sort of like toothpaste, I refer to them as Toothpaste Tech. And when you look at those companies, almost 50% of the S&P's year-to-date gain comes from these Toothpaste Tech companies, and we'll dig into that a bit. So the good news is that despite all these divergences, the reality is that the equally weighted sector leadership remains mostly cyclical, and our market level risk gauges have not yet signaled risk off in any of the 4 timeframes. So it's really just kind of table pounding neutral. And so therefore you want to let that neutral sort of non-trending environment be reflected in your portfolios. As always, regardless of the environment, we want to constantly be continuing this process of upgrading our long exposure, despite the bad breath that we see today. For now, we are also retaining active short exposure because there's just too many charts to short. We're in a range-bound environment, so at minimum, you want to have some short exposure on, and we want to retain that short exposure until our risk gauges inflect positive. Okay, let's dive in here. So the S&P is 1.5% above where it was before Silicon Valley blew up on March 7th. That 1.5% gain is boosting the index's year-to-date gain to 7.68% as of today. So by any measure, here we are in the middle of May, by any measure, that's a great year-to-date gain. Obviously you do the math, you double that, you've got a great gain for the year. So this on the surface looks quite constructive and quite bullish, but we all know how frustrating it's been all year because this is very hard and very difficult to capture. And there's a reason for that. The reason is that almost half the gain, year-to-date gain, comes from what I call management, and these are these 9 Toothpaste Tech kind of companies, and they're mostly recurring revenue stream stocks. So if you look here, the list of names, basically the management is an acronym that I came up with that basically combines these 9 tickers. You can see them down here as well. And the point is that 48% of the year-to-date gain comes from these 9 companies, and they represent 24% of the market cap of the S&P 500. So this is what's actually happening. In terms of driving the index higher. You can see it's all technology, consumer discretionary. A lot of these companies are tied to the current excitement surrounding artificial intelligence. So we can see this theme taking a strong hold here, and on the surface, it's making things look otherwise pretty constructive. The question is, though, is management cooking the books again? And of course, I would argue egregiously. So let's take a look. So here's an index that I created. That's the management index, and this is just an equally weighted index of those 9 companies. And we can see that the management index is not only above its March 6th closing point. You can see it here. It's also above its August 22 bear market swing high. So by most accounts, or by any measure, this index has fully recovered from the bear market from last year. So sounds great. At the same time, however, the average stock, the rest of the companies in the index are not only below their March 6th closing point, but they're also sitting right on their March 13th lows. And that's the same day that the management index bottomed, as well as the S&P. So while the S&P and the management index has rallied to new highs, we can see that the rest of the market is basically sitting right on that March 13th low level, and it's also just slightly below where it started the year. So there's a lot of damage going on beneath the surface here that's simply not being reflected in the portfolios. And it's when you have these large divergences. These divergences are very typical at major turning points. We saw one at the bottom between October and December, where the management index actually went to a slight new low, but the average stock did not. That's the kind of thing you want to look for at a market bottom. But unfortunately, it's also the type of condition or setup that can preempt a market top as well. So this divergence is clear. It's happening between the indexes and the constituents within the index, but we can also see it's not just happening there, but it's also happening at the index level. So the NASDAQ is pretty much the only index that's really making any progress. The S&P 500 and the Dow Jones Industrials are both just kind of tracing sideways, but the remaining indices are pressuring their early March and 2023 lows. So there's a lot of damage again. There's a lot of bear market activity going on. It's just simply not being reflected in the popular averages because of the market cap weighting bias. So the good news is that the cyclical sectors continue to dominate the leaderboard. So we can see here industrials, discretionary, healthcare with biotechs coming on strong as well, and materials and tech. The obvious cyclical loser has been energy, which we can see here. We've been underweight energy, and we actually have been more short than long energy over the past several months. With the collapse in energy prices, we're extremely fragile financials and real estate, the real estate sector. This is just a big red flag, and we don't need financials and real estate to be leading. They just can't be a donut hole. And right now, unfortunately, they are indeed a donut hole. So we can't have that as a backdrop with the anticipation that we're going to have any kind of bull market. So structurally, again, the good news is that there are plenty of buy setups in the cyclical sectors. So this is a model that I have that identifies buy setups and sell setups. And they're all either good charts or bad charts, but they're just varying degrees of timeliness, if you will. And when you look within these cyclical sectors, there's a lot of great setups, which is very constructive. You don't typically see that in bear markets. So score this one for the bulls. Unfortunately, there are also just way too many bearish setups in very important cyclical sectors, energy, financials, and in REITs as well. And when you net them out, the buy setups minus the sell setups, you get a lot of negative numbers over here. So there's actually more sell setups in these sectors than buy setups. So this is, again, just not the kind of environment that you would expect to be rewarded for having significant aggressive long exposure on. Now, for every chart that we can identify, these are weekly charts where we can check the boxes for a buy setup, which you can see here. This is one of our long setups. you can see a nice rounding bottom, head and shoulders continuation, whatever you want to call it, breaking out here with an upward bias, strong relative performance. This is what you're looking for in a bull market. But for every one of these charts that we can find, we can unfortunately find at least one chart that looks like this, which is the mirror image, the opposite of this. So again, this is not the fodder for bull market activity. So to put some numbers on this, again, this is the weekly chart, but if you look at the daily chart, we have this MOTR trend model, which basically assesses every absolute price trend and puts it into one of these buckets, +5 to -5. On the daily chart, +5 is a clear high momentum uptrend, -5 is a clear high momentum downtrend. And the couple things jump off here. So despite the fact that the S&P is up at the top of its range and the management index is painting this picture of a bullish, robust environment, the reality is that 58% of the daily charts in the 2,500 stock MOTR universe are actually in a downtrend on the daily time frame. And then another exercise you can go through is you can look at the buckets and just identify which of the buckets is the biggest. And so within the daily time frame, the biggest bucket is actually high momentum downtrends. So this means that when any rally that we get in here is at least until proven otherwise, it's an overbought downtrend. So that's what we need to be careful about with getting sucked into these rallies, because the structure and the backdrop is just the more overbought you get, the more risky it gets if it doesn't change trend. And of course, we track that every week. So here's this table can also bring to life this discrepancy that we see between breadth and market cap weighted indices. So if you do that same exact exercise, but instead of saying what percentage of the total stocks are in these buckets or in an uptrend versus downtrend, if you say what percentage of the market cap is in an uptrend or a downtrend, you can see this whole relationship flips on its head. And the biggest bucket is actually 35% high momentum uptrend. So this means that 35% of the markets of the MOTR universe's market cap is in a high momentum uptrend. Now we can continue this across the timeframes. The weekly time frame shows something very similar. Most stocks are in a high momentum downtrend, but most market cap is in a high momentum uptrend. Now, as we move out to the monthly chart, now when most people think long-term, I want to get a long-term perspective of what's happening here, most people will look to the monthly chart. And when you do that, roughly half the market's in an actual downtrend. And the biggest bucket by far is a clear high momentum downtrend on the monthly chart. Again, so we're talking about monthly timeframe trends that are driven by fundamentals, right? So these are bad charts in timeframes that are fundamentally driven. However, when you flip that and you look at what percentage of the market cap is in a monthly timeframe uptrend, you get 68%, with 40% of the market's market cap in a high momentum uptrend. So once again, these tables really bring to life this discrepancy between market breadth, which is terrible, and market cap market cap weighted trend, which appears to be quite bullish. And then you take it one step further out. Now we're talking really long-term charts. Most people don't look at the quarterly chart, but it's probably the most important chart to me. And this actually illustrates why. So we can see that, again, if you think the monthly chart's a long-term chart, then you must agree that the quarterly chart is a very long-term chart. And 57% of those charts are in a downtrend. Now, again, you wouldn't know that, or you wouldn't appreciate that if you were just looking at the S&P, which is up 7+% this year. But 57% of the stocks are in a downtrend. The biggest bucket by far is a high momentum downtrend on that time frame. Now, when you do that same analysis on market cap, yes, it's a bit better in the sense that there's 51% of market cap is in an uptrend, but the biggest bucket, again, by far, is a -3. So 31% of market cap in the MOTR universe is a -3, and a -3 is, think about it as basically being an overbought downtrend. So most of the market cap is in an overbought downtrend on the quarterly time frame. So this, again, illustrates the degree of risk that resides within the market today. One other thing I want to point out is when you have a bull market, these breakouts tend to work, right? That's what bull markets are all about. In a bear market, they tend to fail. If you're in a bear market, these kinds of breakdowns tend to work to the downside. They actually oftentimes go down and hit their targets, et cetera. And we've seen a lot of that these days. In a bull market, what you find is when these charts break down, they actually hold and revert higher, and they become bear traps. So we can track this. We actually do track this. And so I track this on all the different time frames, but because these are weekly charts, I'm just showing you here on the weekly time frame. These are the same stats from before. But what we can ask ourselves is, since these uptrends started, right? Again, so this is a high momentum uptrend, and then these are just very consolidations of varying degrees, but they're still uptrends. But since these various uptrends began, what percentage of them are actually at a level that's higher than the breakout point that started the uptrend? And you can see the high momentum uptrends, not surprisingly, 83% are above where they were when they broke out. But then you start getting into these consolidations, and most of them are actually below where they were when they first broke out. So that would be an example of like this stock breaking out and therefore getting into a high momentum uptrend, but then reverting back into the pattern, which again is symptomatic of a market that's just not ready for prime time. It's not ready to trend yet, and we can see that appears to be the majority of stocks of the bull trend. So 56% only 56% of the uptrends are actually in the money since they began trending higher. Now flip that and look at the downtrends, and you can see that 94% of the downtrends are actually in the money since they began trending to the downside, meaning that since they began trending to the downside, they've actually gone lower. And that's the majority across all the different configurations within the downtrends. So again, that seems to map a lot closer to bear market activity, which is something that I just think, once again, we want to underscore the idea that this is not a robust bull market. There's a lot of risk, and so continue to respect that in your portfolio allocations. For those that are interested, this is a list of buy ideas. These are the different setups that exist across the sectors. I'm presenting the table sorted best to worst, first by sector, and then by industry rank. And so ideally, you want to be on the long side. Ideally, you want to be buying strong stocks in strong industries. And then over here by the stock level, we have the trend score, the momentum score, and then the MOTR score, which brings the two of them together. So you can see they're all very positive. So you want to focus here for long ideas, being mindful of the possibility that this is the environment that we're in. Well, not the possibility, the reality that this is the environment we're in. So you want to continue to keep your risk allocated to each of these ideas on the low side. You have to take these trades, continue to take them just because of the environment we're in. You want to kind of curb your enthusiasm, if you will, until the risk gauges change. Here's a list of short ideas, very comparable. This is, again, sorted best to worst sector, and then within the sector, sorted best to worst industry. And you want to be focusing your exposure ideally in weak industries within weak sectors. But all of these, as you can see from a trend momentum perspective, and of course the MOTR score, they all qualify as being shorts. So all of this, again, filters up into our risk gauges. And remember, the risk gauges are based on concepts that I refer to as the inviolable rules of trend following. There's 5 components in the risk gauges, and I measured these 5 components across 4 timeframes. So it's a very comprehensive bottom-up process. The 5 components are price trend, relative trend, cross-sectional momentum, market breadth, and volatility. Those 5 concepts make up these risk gauges, and they're all based on inviolable rules of trend following. So just by way of example, just to recenter your understanding of what that means, as one example of the many things that go into these models, if you have a stock that's at 10 and you're worried about it taking off on you and going into 50, we know for sure that it can't go from 10 to 50 without going past 12 first. So that's an inviolable rule of trend following. It's a very clean, very clear-cut definition of what is versus what is not opportunity, what you are versus what you are not missing, et cetera. This entire model set, these risk gauges are based on those kinds of concepts. So and when you look at it, we are at the market level, we are painfully table pounding neutral. There's no trending activity going on anywhere at the individual stock level. Remember, these are all bottom up. This is not influenced by market cap. The leading sectors have decent scores. Most of them have scores that are in the high end of mixed. So you can see here and through here, we have some that are risk on. But most of them are high end of mix, which is good. But also the fact that there's not a lot of risk on tells us that we're just not in that robust high momentum bull market. You know that already, but the point is that this modeling process, if history is any guide, this modeling process will pick up on the positive trend changes before the indexes actually break out. That's what this whole process is about. It's trying to identify from the bottom up where trend change tends to take place first, trying to identify it before the market actually inflects to a positive trend, so we're not getting in late. But you can see here, there's very few sectors, even amongst the leadership, that's displaying that kind of activity. So we again, just be patient with what we're seeing here. And then when you look at the lagging sectors, these are generally poor readings across all of these lagging sectors. The lagging sectors don't necessarily have to be healthy per se, but unfortunately they can't mostly be cyclical, and unfortunately that's what we have today. We have technology, media, energy, financials, and REITs. I mean, it's okay to have one or two in the lagging position, but the fact that most of these are cyclical sectors is troubling. It's again, it's not a hallmark of a bull market, and they most certainly should not all be dominated by risk-off readings. And you can see that there's just a tremendous amount of risk-off readings in those important long-term trend timeframes too. So again, it's okay to have financials not leading, but to have financials lagging with bad structure. Again, most banks are actually down since the market bottomed, et cetera. And you've got a lot of risk-off readings in banks, financials, and real estate. Again, this is just in such an important sector. This is just not a healthy backdrop. So once again, just be mindful of this. Just to reiterate this notion with banks, they really need to hold here, because we've reached a point where we're at a major support area, and if banks continue to go lower from here, it just strikes me that the bearish evidence that I've been pointing out, although it doesn't appear to be holding sway in the market right now, the point being that if this gets worse from here, even those large cap names will start to succumb to the selling pressure, because at that point we would potentially see the quarterly time frame of the market gauge drop into risk off, which of course would be a very, very high risk environment. And again, keep in mind, this is all breadth related. So we want this for the very reason that this is hovering just above risk off on that quarterly time frame. Remember, I told you that the majority of stocks are in downtrends in this time frame. The very fact that this is hovering just above risk off shows you how close we are to having a risk off environment really take hold here. So for this reason, we need to see banks hold. So after hitting the head and shoulders top target that it sort of activated at the beginning of the bank crisis, since then, most stocks have actually gone on to hit new lows, as you can see, both at the ETF level and at the individual stock level. So since March 13th, here's the banks. Most banks have actually gone lower. All financial industries are lower since the March 6th crisis began. But even since the market itself bottomed on March 13th and the management index bottomed on March 13th, most banks have actually gone lower since then. So again, the S&P is above this comparable level, and the bank index, the bank ETF, is down here. So again, this is just not healthy. So relative, of course, as a consequence, is very weak. This is an ongoing saga. This is, relative performance in banks peaked back in, I think it was 2004, 2005. So this new relative low by banks shouldn't be surprising. It's been an ongoing downtrend, but the fact that it's destabilizing potentially the rest of the market, that's what actually matters. So major support is right here. This is a support range that was formed and developed during COVID. After hitting the downside target for the head and shoulders top pattern, we've then moved deeper into this range. So again, for this very reason, this is where we should expect it to find support, but this is also where we need to find it hold support here. So in my portfolios, I've been short banks. What I've done is I've cut back some exposure at the individual stock level in the sense that I've reduced exposure. I haven't yet covered any individual names, but because they've gone in the money so much, and we've now reached into this support band. This is a good spot to take off some of the exposure, but there are plenty of other areas within the market to engage with new short positions, as I demonstrated on a previous page. So in summary, for now, there are too many good things happening to not have long exposure. There are also too many bad things happening to not have short exposure. So what that works out to is a low gross exposure overall, which is accomplished by taking down the risk per position, not the number of names. The main thing to keep in mind, and this is a core tenet to our portfolio management process, is to constantly be upgrading the portfolio, even during bear markets, because ultimately, when the bull returns, you want to already own the names that you want for the next bull market. All you then would need to do is just when the risk gauges inflect positive, cover your shorts if you haven't already, and then just gross up your long exposure so that you're fully invested as the new bull market begins, and not scratching your head and trying to react to that, as opposed, reacting to it as it's happening, and not really making quality decisions. So these are all, right now I have about 45 names on the long side of the book, and if things work out well, and the risk gauges eventually inflect higher, I already own what I want to own for the next bull market. This is a very important aspect to how we tie the research process to our portfolios. And so in the best of scenarios, the risk gauges will start to uptick, and all I need to do is gross up the long book and be ready for the next bull market. Okay, so that's what I have for you this month. Keep an eye out for our monthly, or rather our Monday morning weekly motor reports, and our Friday afternoon charting my interruption notes. And both of those notes will keep you posted on what we're seeing through our lens, our technical and momentum trend following lens in the markets, as well as continue to share timely buy and sell ideas. If you have any questions, as always, please feel free to reach out to either myself or Rick Casella, the Director of Business Development here at MOTR Capital Management. And both of our emails are here. So thank you, and we'll see you next month.